Hey everyone, Aaron Benton here, local mortgage lender. Today we're going to talk about a VA interest rate reduction loan, otherwise known as a VA IRRRL. Such a powerful tool, but you got to qualify for it. You have to be VA eligible. But the product is designed to lower your interest rate, lower that monthly payment, and keep those closing costs in check. Upfront cost to you, absolutely minimal on a VA IRRRL. Again, my name's Aaron Benton. I'm host of this channel and local mortgage lender. I encourage you to subscribe below and tap the bell for notifications so that you'll be the first to know whenever I release a new video. I get calls, emails, texts every day from people just like you looking for home financing advice. So whether you're looking to purchase or refinance in a week, a month, or even a year, reach out so that we can build a plan tailored exclusively for you. But today, we're gonna talk about the VA IRRRL, that interest rate reduction loan, right now. So the VA IRRRL, the first thing you should know is that it's different than a cash out. So on a VA cash out, that is when you're gonna take money out, or maybe you're refinancing from a conventional loan to a VA loan. VA loan you originally had, and then you've refinanced into another VA loan. It's specifically designed, it's in the name, rate reduction. You're doing it simply to lower your interest rate. You can't get cash back. Well, what is so beautiful here is that on a VA IRRRL, the funding fee is 0.5% of the loan amount, whereas on a cash out refinance, it's 3.3% of the loan amount. Vastly different. Now, maybe you're exempt from the funding fee, which makes it even better because there is no funding fee to pay. So therefore, no 0.5, it's zero. And it would be zero on the VA IRRRL or a cash out if you're exempt. But VA IRRRL, 0.5%, much better. Now, the other part is that the loan is extremely easy from you as the consumer part. You don't need an appraisal. You don't need income docs. That is such a powerful, you do not income qualify. So understand, maybe you switched jobs. Maybe you went from an employee to being self-employed and you're thinking, I can't actually qualify for a loan right now. I am in limbo. Not the case. The interest rate reduction loan is only worried about putting you in a better position at closing than you were when you first started. So it's truly designed to make your life better. So no income. The other part there is really, instead of verifying that you're worried about the income, we're verifying that you made your payments the last 12 months. Now, of course, if you own the property for less than 12, then we're gonna verify that you made the payments while you own the property. So very, very powerful there. The next part is the rate. The rate has to go down 0.5% or half a point. So understand that if it's fixed to fixed, then it's 0.5%. Now there is an option that goes from fixed to an adjustable rate, but in fairness, I don't want to talk about it in this video so much because I don't really care for that option. I think that if you're already in a fixed rate loan, you should stay in a fixed rate loan. It is a very powerful tool for you there. So 0.5%. Now there's also another caveat. I get a question a lot, how often can I do this rate reduction loan? It sounds almost too good to be true. Can I do it every month? No, it works out to be about 7 months. You can refinance about every 7 months. So I talk to my clients and I kind of put them on a little list, if you will, and I reach out to them. I say, hey, you know what, in about a couple months, if the market continues to get better, again, rates need to go down, it needs to make sense, then we can look at doing a rate reduction loan for you. So 210 days is the typical going number, but that works out to be about 7 months. Now, the other perk here is that the closing cost vastly reduced. I know that our company charges a reduced rate when we do a VA IRRRL. You do have to pay for title, and maybe that's an attorney fee, title company fees, and escrow. So whatever their fees are, those still would exist because it's a refinance. Now, depending on what states you live in, there might be some taxes or fees associated with that. But you are going to have title and escrows. Now understand, an escrow account, that's not a fee, it's really just your money. It is a piggy bank that is comprised of tax and insurance money. So you never have to make a tax bill payment, you never make an insurance bill payment in your life. Basically, you put money into this escrow account, you pay every month, you have 12 monthly payments. Each month you pay principal and interest, you pay 1/12 of your taxes, you pay 1/12 of your insurance. The mortgage company package up those 12/12s, the whole, and they pay the tax bill or the insurance bill on your behalf. So that's a little bit about an escrow account. Now, when you refinance, if you've been funding this escrow account, and again, this loan is going to be replaced with your new loan, that escrow account is going to go dormant, meaning there is a bunch of unused tax and insurance money. Well, on the new loan, we're going to have to fund or build up some reserves in your escrow. So you do have to fund this new escrow account. Well, what we do, maybe not, you don't have to do this, but you can roll these upfront costs, title, attorney fees, and escrows, and you can roll those into the loan, essentially financing those. But remember, if you're saving at least 0.5%, a couple $1,000s that gets financed in the loan, you're still gonna see significant savings on a monthly basis. So rolling those costs into the loan, not a bad thing. What you do need to watch out though, is if someone is coming to you and saying, I've got this really low rate, but they're charging you points. So points are an upfront fee. Think of it as an upfront fee to get a lower interest rate. You're kind of prepaying, if you will, to get a lower rate. Well, when I do a refinance, I want someone to be made whole, meaning that upfront cost you have to output to refinance. If you can recoup that upfront output within 12 months by your monthly savings, then I think it's a slam dunk to do the refinance. By paying points, that could push off into the distance your break-even period, off into 3, 5, 7 years. It's just simply too long. So yeah, paying points can make sense if it's a small amount of money. You probably will be able to say that you got the best interest rate at the cocktail party, but I don't know if that's necessarily in the cards for you, but we can certainly look at that option. Now, what people do is, if I take that escrow money that you have to pay, you gotta front your escrow account, you gotta pay for your attorney, and say you roll those into the loan, essentially you're bringing no money to closing. You financed it. Now, the beauty of the escrow account, remember you had the old escrow account in your prior mortgage, there's still money in there. You've been funding that account all year. Whatever is in that account is gonna come back to you 3 to 4 weeks later in the form of a refund check. Imagine you needed a little bit of a pick-me-up. Maybe it's $1,000, $2,000, $3,000, whatever is in your escrow account. You look at your mortgage statement, you see what's there, you do a VA IRRRL, you finance the closing costs, and suddenly 3, 4 weeks later, you've now walked into some money that you can use. Maybe it's paying down debt, maybe you have to do some holiday shopping, whatever that is, you've now come in and inherited this escrow money from your prior account. So that's how many times we structure the VA IRRRL, because I get asked many, many times, hey, or told, I really don't want to bring any money to the table. Well, you finance the escrows, you bring no money to the table, and then you turn around and you get this refund check back 3 to 4 weeks after closing, and you're obviously walking away as a happy person. So the VA interest rate reduction loan, it's beyond powerful. It's designed specifically to lower your monthly payment. And again, the minimum is 0.5%. So watch out for the points. If anyone's charging you points to get there, put your antennas up. Does this make a whole lot of sense? Also, in the terms of the upfront cash that you would eventually finance, if you can break even and recoup that money within a year, in my opinion, that's a slam dunk. So VA interest rate reduction loan, very, very powerful tool. My name is Aaron Benton. I'm host of this channel, Local Mortgage Lender. I hope you really enjoyed this video. I know that I enjoy talking about it. I think the IRRRL is a very powerful tool. I think it does get utilized, but I think some people are kind of in the dark in terms of when does it make sense. Hopefully that shed a little bit of light for you. Again, you can always subscribe to my channel. You can give me a call, shoot me an email, send me a text. My phone number is 843-505-5623. I'd love to understand your personal situation, and we can certainly build a plan tailored for you. So I hope to see you one day. Maybe we get to talk over Zoom, but if not, I'd like to at least see you on the next video.